Good afternoon, everybody. Welcome to Tuesday's Liberty Call. It is July 12th, 2022. Hope everybody's having a fantastical day out there in the interwebs. If it's your first time watching this show, give me a big old thumbs up, a like, a share, subscribe, all that great stuff. Greatly would appreciate it because I'm sure there's a lot of folks out there who are like, well, what the hell's going on in the financial world right now? So, hey, there's guys like me who are just, regular Joes who are in this business who love helping people. So, anyways, not the best day in the markets. Things look pretty good most of the day, and then things just kind of turned to crap at the bottom half of the day. So let's go ahead and jump in and take a peek at how today's indexes did. Dow Jones finished down 0.62 at 3981. The S&P 500 was down 0.92 at 3818. NASDAQ down 0.95, closed at 11264. Small caps were basically flat. They were down 0.12. The VIX climbed 4.28% today to 2729. For those who are playing along, anytime the VIX is in the 20s, that's kind of your yellow light if you're approaching an intersection. And when it goes over 30, to me, that's the red light, and proceed with extreme caution if you want to run that one. So anyways, actually the VIX was up most of the day, even with the markets in the green through, definitely through the morning and early afternoon. The VIX was in the green all day. So that kind of was a telltale sign that things were, probably going to tip over at some point today. All right. Canada finished down 0.73. Brazil was flat at up 0.06. Mexico up 0.56. Moving on over to Eastern Europe, Germany up 0.56. The UK up 0.18. France was up 0.8. The Euro Stoxx up 0.44. Netherlands up 0.23. Spain down 0.62. Italy down 0.38. Switzerland up 0.39. Portugal finished down 1.34. Let's move on down to some of the other exchanges. The MOEX in Russia was down 1.32, while the RTSI was down 1.03. Moving on over to the Asian markets, Japan finished the day down 1.77. Australia up, or basically flat, at up 0.06. New Zealand flat at down 0.01. Headed over to China, the Shanghai finished down 0.97. The SE component down 1.41. The China A50 down 0.97. The DJ Shanghai down 0.84. And the Hang Seng down 1.32. And the Taiwan weighted came in down negative 2.72%. So a lot of red on today's screen. Things were best in Western Europe. And things were pretty decent here today until things kind of fell flat. So, all right. So that's what's going on there. Let's go ahead and read through today's market recap. S&P 500 gives up gains as energy slips, financials lose steam. The S&P 500 slipped Tuesday as energy stocks wobbled on falling oil prices, and financials ran out of steam ahead of the quarterly earnings from major Wall Street banks due this week. Energy stocks fell more than 2% after OPEC flagged fresh demand concerns, forecasting oil demand to rise at a slower pace in 2023. The downbeat forecast added to concerns that oil demand will remain in the crosshairs as global economic recession fears mount. Financials gave up gains even as banking stocks climbed on bets that the second quarter from Wall Street banks due this week may not be as bad as feared. Growing worries about recession had soured investor sentiment on banks recently, but 2Q results should be strong, as should the outlook, as it is too early for banks to build meaningful loan loss reserves for a potential U.S. recession, Deutsche Bank said in a note. JP Morgan kicks off quarterly earnings season in earnest on Thursday, followed by Citibank and Wells Fargo on Friday. The gains for bank stocks come against the backdrop of falling treasury yields, a drag on bank stocks, though many point to inflation data due tomorrow that could cement bets on the Federal Reserve hiking rates by 0.75 point again this month. Quote, we expect still strong 0.5% month-over-month core CPI inflation in June, setting up another 75 bips hike at the July FOMC meeting. Inflation expectations data bear monitoring, end quote. Nomura said ahead of the Consumer Price Index data due Wednesday. That is tomorrow, folks. In big tech, meanwhile, Microsoft was the biggest loser, falling 4% after the tech giant announced job cuts that would affect less than 1% of the company. The job cuts come just as tech research firm Gartner reported that PC shipments fell 13% in the third quarter, stoking doubts about strength of demand for Microsoft Windows operating system segment. Twitter, meanwhile, rose more than 4% to claw back some of its recent losses after it said Elon Musk's allegations that it had breached the terms of its $44 billion deal were, quote, invalid and wrongful. Really? Yeah. Because Twitter seems like a very trustworthy organization. Twitter is likely to, quote, go head-to-head against Musk in the Game of Thrones court battle to recoup the deal and/or the breakup fee of $1 billion at a minimum, according to research firm Wedbush. Well, here's kind of my thinking is that, and I talked about this yesterday, this is all part of Elon's plan, or at least in the grand scheme of things, either to wreck Twitter altogether or to take it over at a much more fair price and really flesh out all the, what's the word I want to use here? Fraud in their company. And, he has a point. I mean, there's a lot of bots and fake profiles on their system. And, he's just asking to see what is real and what isn't. So, again, we'll see what happens with that. But in the end, I think he's going to win this battle just because I just don't see them being able to, get past. And I think they have a bigger problem because if, it does go to court, there's going to be discovery. And at that point, he should be able to prove his case that there's a lot more fraud in their system, or at least fake accounts. And, that could open up bigger worms for shareholders. And, if they've been lying on SEC documents that, they have so many people that are using their system, and that's what they're using for charging for advertising. I mean, some of these advertisers might get pissed and start to file lawsuits. So again, they may be opening up a can of worms that they may not be prepared to deal with. All right. On the earnings front, PepsiCo gave up gains to trade lower despite raising its full year guidance after quarterly results topped Wall Street estimates. Boeing, meanwhile, reported that it delivered 51 airplanes in June, topping the 50 milestone for the first time since March of 2019. Its shares rose about 8%. In other news, Peloton Interactive said it would outsource in-house manufacturing to Taiwan to cut costs and simplify its supply chain structure at a time when the fitness equipment maker is facing waning demand. Well, there's plenty of fat people in this country. They could probably, that's what we should have done 2 years ago instead of, creating $5 or $6 trillion. We probably just, if they wanted to spend any money on stimulus, they could have bought an exercise bike for all the fat people in America and get them in shape so that they wouldn't have been in any danger from catching the danger cold. So, all right. Next article has to do with oil. Oil took a big step back today. Another Tuesday tumble, and Brent closes below $100 for the first time since March. The oil bears are getting more optimistic that a barrel beneath $90 might be possible after all. Crude prices tumbled more than $8 a barrel on Tuesday, the second major loss in a week after the $10 drop 7 days earlier, in a sign that oil may break new bearish ground since the post-Ukraine invasion rally. London traded Brent closed below $100 a barrel for the first time since March, when Russia's invasion of Ukraine sent a barrel of the global oil benchmark to nearly $140. In Tuesday's trade, Brent settled down $7.61, almost 7.1%, at $99.49 a barrel. Brent is also down some 9% for July. New York traded WTI crude settled down to $8.25, or almost 8%, at $95.84 a barrel. The U.S. crude benchmark got to around $130 after the Ukrainian invasion. It has lost 10% since the start of July. Quote, 7% down moves in a day is big, said John Kilduff, founding partner at New York energy hedge Again Capital, said, referring to Tuesday's action in Brent, quote, will some of this get retraced? I have to believe that. But we have a nice downtrend. The 2-day moving average is in the neighborhood of $88, end quote. WTI technical charts are by Skycharting, or skcharting.com, suggested a deeper drop ahead if current momentum held. Quote, WTI looks all set to visit 200-day simple moving average of 93.90 and a 50-week EMA exponential moving average of 92.70, end quote. The firm's technical strategist Sunil Kumar Dixit said, referring to respectively to the simple moving average and exponential moving average. Quote, there may be short-term rebounds towards 102, 105, 108, but if intense sell-off pushes through the two support levels, doors may be open for vertical support areas of $85 to $83, end quote. Tuesday's rundown in oil came as a dollar index, which pits the U.S. currency against 6 other majors, hit new 2-decade highs, reaching almost 109 points. A stronger dollar typically makes crude and all other commodities priced in the greenback costlier for those using other currencies. In China, fresh curbs on social activity and business after new infections from the highly infectious BA.5.2.1 subvariant of Omicron led to fears that authorities in the number 2 economy might overreach again in their response to the pandemic. Beijing's, quote, zero COVID, end quote, policy has been cited by many as causing more economic damage than good in health terms. Reuters, meanwhile, reported that investors have been dumping petroleum-related derivatives at one of the fastest rates of the pandemic era as recession fears intensified. Hedge funds and other money managers sold the equivalent of 110 million barrels in the 6 most important petroleum-related futures and options contracts in the week of July 5th. July's tumble in oil also undermines OPEC's optimistic global demand forecast for oil going into next year. The 13-member Saudi-led oil exporters group expects average global oil demand to hit a record high of 103 million barrels daily in 2023. Forecast is based on the assumption that the war in Ukraine will not impact economic growth and China will overcome COVID restrictions. The White House on Monday prodded OPEC, particularly the Saudis, to put out even more oil, saying it believed that oil exporters group had the capacity to do so. Quote, we do believe there is capacity for further steps that could be taken, end quote. White House National Security Advisor Jake Sullivan said days before U.S. President Joe Biden was set to visit the Middle East, where he will hold talks with with leaders of the top OPEC oil producers. Again, a little relief there, and anyone who's been paying attention to what I've been saying or has been has participated in some of my meetings of late. My view is, we're not really going to see a lot of relief at really across the board. From food costs to running a household or running a business until energy prices subside. Once those subside, we'll get some relief, and at least again, in my opinion, we'll get some relief across the board. But too soon to tell. It does look like the chart is shaping up that things could be trending down for oil prices. But again, a couple of days does not make a trend. We'll have to see where the momentum is taking it long term. All right. Next article here. This is a new one. This recession may be mild. The second one will be worse. Written by Robert Heller. This comes from Barron's. And Robert Heller is a former member of the Board of Governors of the Federal Reserve System. So, I imagine he probably has a little bit of intelligence, although he did work for the government. So we know what government employees are like. They're not the brightest folks out there. All right, starting out. The U.S. has now likely entered recession, and the chances are good that this will be the first dip of a double dip downturn, thereby repeating the experience of the early 1980s. The most recent data published by the Bureau of Economic Analysis shows that real gross domestic product decreased at an annual rate of 1.6% in the first quarter of this year. And GDP Now data published by the Atlanta Fed pegged the growth rate for the second quarter at a negative 1.9. Many economists regard 2 quarters of negative growth as a recession, but it is up to the National Bureau of Economic Research to make the official call, which usually takes them quite a long time to accomplish. Again, government, they don't do anything fast. A number of factors have contributed to the economic slowdown. Among them are the cessation of federal stimulus payments to individuals and corporations, as well as significant slowdown in construction and goods-producing industries. However, Federal Reserve policy is still highly stimulative. The official Fed funds rate is now pegged at 1.5 to 1.75%. But the consumer price index has risen by 8.6% over the last year, yielding a real or inflation-adjusted Fed funds rate of approximately minus 7%. This is highly stimulative of Fed funds rate by any measure. Similarly, longer-dated Treasury bonds offer only negative rates of return in the neighborhood of minus 5%. If the policy of the Federal Reserve were truly restrictive, one would expect the Fed funds rate and Treasury yield curve to be above the inflation rate, which I've been complaining about for months. If these folks were serious about it, they'd jack rates up faster than they're doing, but these little nibbles, just aren't doing a whole lot. The prevailing financial conditions are more indicative of further positive economic growth prospects than a continuation of current mild recession. Consequently, we may look forward to a resumption of economic growth in the second half of the year. Again, I don't see where this is coming from. Everyone, from the Fed and all these, big brain people continue to think that we're going to have a good second half. I just don't see it. This may be good economic news for those of immediate economic future, but it would do little to rein in current fires of inflation. Federal Reserve Chair Jerome Powell has expressed several times his determination to bring inflation under control. This will require the Federal Reserve to continue its steady march to increase the federal funds rate and to shrink its enormous balance sheet, which it has done very little of so far. These actions will also reduce the excessive growth of monetary aggregates. If these promised restrictive monetary policy measures are implemented in the second half of this year, the economy will slow down significantly early next year, especially in the interest rate sensitive sectors. As a result, a double dip recession is highly likely. The mild recession of the first half of 2022 may well be followed by a more severe recession in early 2023. Yay! So we got that to look forward to. Thus, we might experience a repeat of history of the early 80s when the United States experienced a double dip recession. The initial dip occurred during the first 3 quarters of 1980, followed by a second dip that lasted from the third quarter of 81 until the fourth quarter of 1982. And that would be the good news. The bad news would be if the Fed caves into enormous pressures that it will face because of rising costs of servicing our ballooning national debt and does not raise interest rates sufficiently to beat down inflation now. That would weigh down the economy for an indefinite future with all the inefficiencies of high inflation. Fortunately, Powell has made it clear that is not an option. Yeah, because again, these fools who run things did such a good job over the last 2 years by jacking up the money supply and handing out cash to people who really didn't need it. So, but hey, we have faith in them now, right? No. All right, last article I got here. Some bad news. From my old days of being working as a collection and recovery agent, typically when delinquencies start to rise, that's kind of like they say here, canary in the coal mine, that there's worse things on the horizon because the deadbeats are usually the first ones to lose their jobs, get behind on their bills. And they're the best sign of where things are going. When those folks are flush with cash and doing well, usually the economy's going all right. All right, canary in the coal mine, repos from auto loans that originated in 2020 and 2021 are skyrocketing. And I apologize if I insulted any deadbeats out there, but y'all are a pain in the ass. Pay your bills on time. If you're looking for proof that we're already in the midst of a meaningful deleveraging, look no further than car repos. In fact, the industry is, quote, underappreciated ticking time bomb, end quote, according to Barron's. One car dealer said this week that most loans on cars currently being repossessed originated during 2020 and 2021, a trend that differs from the norm when origination dates are usually scattered. Quote, many of the loans were extended to buyers who had temporary pops in income during the pandemic. The dealer, who has been in business for 20 years, told Barron's the monthly incomes of many of those who took on the loans have fallen, quote, sometimes by half now that stimulus programs have ended, the report said. Excuse me. Consumers' incomes were temporarily high as a result of debt forbearance, pandemic stimulus checks, enhanced unemployment benefits, and PPP loans, the report says. The auto dealer says he bought a Bentley, McLaren, and 2 Aston Martins from 2 buyers, now in default, who used PPP money for down payments. Yeah, that's smart, using government loans to buy several cars. Quote, everyone thought the free gravy train would never end. I'm not sure who would have thought that. End quote, he said. He told Barron's he has, quote, never seen so many people making $2,500 a month owing $1,000 a month in car payments, end quote. Quote, the idea that the economy is strong, anyone who is actually doing business sees things are not strong. We had a housing bubble in 2008. Now we have an auto bubble, end quote. He continued, he guessed, based on data he has seen from banks, that, quote, subprime repos have nearly doubled since 2020 to around 11% on average, end quote. Normally, about 2% of prime loans wind up being repossessed. That number now stands at about 4%. Continuing data on repos is difficult to find, the industry insider said. Quote, a lot of banks, they're smart. They control the market like diamonds. As repos pour in, they only release them so often, end quote. Quote, the bubble is beginning to show signs of bursting, end quote, said Pamela Fuhi, law professor at Cardozo School of Law at Yeshiva University, who was one of the first to warn about trouble in the sector back in 2021. Auto debt is now about 10% of all consumer debt, rising $87 billion for the year ending March 2022 to a total of $1.47 trillion. And as Danielle DiMartino Booth, CEO of Quill Intelligence, correctly points out in the article, automobile retailers are usually the canary in the coal mine when it comes to economic trouble on the horizon. Recall back in May, we noted when cracks in the auto market started to appear. At the time, the Wall Street Journal reported that millions of Americans with subpar low credit scores were falling behind on paying their credit card and automobile and personal loans. At the time, we called it, quote, an ominous sign the, quote, strong consumer narrative is cracking, end quote. Data from credit reporting firm Equifax Inc. in May had already started to show a rise in the share of 60-day delinquencies for subprime credit card and personal loans. Those delinquencies hit an 8-month high in March, during levels not seen since before the virus pandemic. Equifax's data also showed subprime car loans and leases soared to a record high in February. The data goes back to 2007. And you can see here on this chart, auto loans and leases, credit cards, and personal loans and lines of credit, how in the last, over the last, 3 years, especially auto loans have gone from about a 7 number to up over 8. And, credit cards have actually come down, or they were down a year ago and have slightly climbed up over that same period of time. Same with personal loans. So, all right. Well, that's everything I had for today as far as articles and interesting information. So I hope everybody got something from this. If you didn't, I'll do better tomorrow, maybe. So, all right. Well, if anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information is there: phone, email, smoke signals, whatever you want. If you want to book a meeting, there's a link there to book a meeting with me if you'd like to discuss, retirement planning or just investment planning or whatever the hell you want to talk about. I'm always here for you. So, hope everyone has a fantastic evening, and I will see you guys tomorrow. Adios.